Well, let's kickstart the Money Show then and bring on board our very special guest for today, Mr. K. Ganesh, the founder of GrowthStory. Ganesh, thank you so much for taking our time and joining us today on the Money Show on this very special interaction. It's a very different one. You know, Ganesh, our retail investors, for them, when you invest in the equity markets, it's via mutual funds, or then it's via, the plain Jane businesses on Dalal Street today. You have a FMCG company which is selling products and services. Then you have a banking company which is into lending and deposit businesses, so on and so forth. Now enter a flock of brand new disruptive businesses that bring along a completely different business model. I won't be surprised if they get an index as well of their own very soon for the markets. Now, you've been investing in them. You've been in these coterie of companies much before they hit Dalal Street. What is different in these companies, in these new age companies, the ones already come in, that Zomato, the ones that are set to come, versus your traditional consumption, traditional banking companies?
Yeah, so good question. Obviously, I'm slightly biased towards technology and the new age companies. So clearly, I do have that bias. But technology is really different. Tech is different. The last 2 years of pandemic has shown technology companies are scalable. They're highly cost efficient, and they can create large monopolies world over, whether it is Google or Amazon or Facebook or Twitter or Apple. You can create by existing and executing correctly, you can create large monopolies. Tech is the future. So whether a retail investor or an institutional investor needs to have exposure to it. That does not mean automatically that you should buy new unproven tech IPOs at issuance. People need to get over the home country bias and buy tech stocks as tech is different and is the future. So that is the overall theme here. COVID has shown that the power of tech companies and companies as consumers are rapidly moved online due to lockdowns, due to safety concerns, which have devastated really the offline business. The trend has been clear over the past few decades, but COVID has really accelerated the shift, especially in India. Consumers actually in US, Europe, and China had already moved online in large numbers. So if you see the US indices, most of the large cap companies are tech giants. This shift of consumers moving online would have taken longer in India. But thanks to pandemic, everyone is online for shopping, for education, for healthcare. But fortunately, the building blocks were in place. What are the building blocks for this technology models to work, or Zomatos and Paytms and Nykaas to work? The building blocks are widespread smartphone adoption, very high-speed mobile networks, digital payment infrastructure, low cost of data bandwidth. All of that has helped these tech business models.
Well, yes, the pandemic certainly has pushed things along, especially from the India perspective. All of us have used Zomato, all of us have used services like WeFast, etc. So that's definitely there. Now, Ganesh, you've been investing in companies like these much before they came to Dalal Street. What were the factors that you looked at when you thought of, okay, this is a good business model, or I don't see much promise in this? What did you look at?
So, see, tech not only makes consumers' lives more convenient, they also help businesses scale much more efficiently. So, companies can actually reach hundreds of millions of consumers with a simple app instead of actually opening stores, physical stores across the country, which would take billions of dollars. So, literally, can software or technology come and disrupt our existing status quo? Can they make the business more scalable without linearly increasing the salary or the rent or the infrastructure? So technology brings in efficiencies. Over time, artificial intelligence or machine learning can be used to optimize the business operations and make them super efficient. That will increase the profit. So what I look at is is the technology being used for capital efficiency, for scalability, making the company a lot more valuable? So that's one aspect. The second aspect people tend to ignore, or they still need to lack the appreciation of it, is the entire business of virtuous cycle or network effects of businesses which are, say, platforms or aggregators. So what happens? What are these network effects? If you look at a platform where you have sellers and buyers, or take, for example, a Uber or a Ola, where you have drivers and riders, okay, right? People who are driving the car in this. So this platform is such that as more and more drivers come in, the wait time for the consumer reduces. As the wait time for the consumer reduces, it's a lot more easier and convenient for the consumer to order a cab on Uber or Ola. Okay, right? Now, that leads to a lot more consumers coming in. When a lot more consumers come into Uber or Ola, because the demand is there, you will have a lot more drivers joining Uber or Ola. So this is a virtuous cycle that gets set up. Okay, the demand side feeds the supply side feeds the demand side, and it becomes stronger and stronger and stronger. Okay, that's one example. Take the example of Zomato or Swiggy. So if you take a hyperlocal area, say for example Koramangala in Bangalore, if you have a number of drivers delivering restaurant food in Koramangala, so what happens? Because the number of consumers are high in that small density area, the delivery times are faster, the delivery costs are lower, the consumer is benefiting from quicker delivery times and cheaper delivery cost. That in turn attracts more drivers to join in and be on the Swiggy or Zomato platform. They get more business. Earlier they used to get business, but it used to be across Bangalore as a city. The travel costs and time was very high. Now suddenly everything is happening within a micro market of Koramangala. So therefore they get to deliver more packets or more orders in a much shorter time for a much lower cost. They have to travel less petrol, so they benefit. So you see the virtuous cycle here. The restaurant is benefiting, the consumer is benefiting, the driver or the gig economy worker is benefiting. So this is a beauty of platform or aggregator businesses, which was never possible in the old economy business. So what we look at is there a way technology is used to disrupt a business model, become more and more powerful as times go by? Is there a network effect or a virtuous cycle effect in the business so that they will become extremely profitable as time goes by? Amazon is a great example in the US. What has happened? They used to lose money consistently, but slowly they become the de facto standard for online retail. People started searching on Amazon first. They started buying on Amazon. That in turn attracted a lot more suppliers to sell on Amazon. So more customers, more suppliers, virtuous effect. That is really what we are looking at in terms of these business models.
So you said you look at, the network effect, you look at how tech is being used to make the company more valuable. But as the company has grown, it's proved its mettle, it's gone up in size and scale, and now it's of course listing on Dalal Street. So there are a whole host of other factors as well. How do your parameters change, or do they remain the same? Do you still look at the same kind of parameters that you look at before they come on listing? Just to get a sense of, how we should look at the new businesses now that will list, like Nykaa, Ola, etc. They've already proven on those points that you have shared. So now what do you look at?
Yeah, no, that's a great question. To be honest, I'm not a public market expert. So this question is best answered by people on the Dalal Street and people who actually are analysts who do the thing. The way I look at it is in the Dalal Street, it's a slightly different way because the stock is liquid. It gets traded every day, in fact, every minute. There is a demand based on the demand and supply at this particular minute, the price may go up or go down. What I talked about in the early stage as a venture capital investor or angel investor is looking at the future, not looking at everyday movement. Whereas in Dalal Street, when you're public, you are really getting evaluated every day, and the price can vary based on if there is more demand or more supply. It will determine the price. So I will not really be able to comment on that, but very clearly some guidelines from global markets are there for retail investors to see. If you look at the US market, the retail investor in US market has made tremendous return by betting on these disruptive technology companies. Today, more than 40% of the indices of Standard & Poor is dominated by technology companies and have created immense wealth for US retail investor. Now, I expect at the macro level the same thing to happen in India. If we were having the conversation 5 years down the line, I will not be surprised that Indian stock indices, which have been dominated by banks and by FMCG companies, you will see a lot more of these new age tech companies dominating there. That means there is value to be made, there is money to be made, market cap of these companies will go up and retail investors can participate. I will not be able to comment on specific stock because I don't play in the public listed market. So is Zomato overpriced right now or underpriced? Should you buy Nykaa? Should you buy Paytm when it gets listed? I don't know. But my sense is, unless you get lucky, IPO allocation is very difficult. If you get lucky, please capture the opening day pop. Other than that, seasoned retail investors should wait, watch and accumulate these tech stocks over a period of time. Start building small positions in tech giants going public and build a diversified portfolio of tech companies over time. The valuation is a concern, always will be a concern. How do you value a loss-making company at tens of thousands of crores of rupees? But by buying small amount of shares in each company over next 3 to 4 years, investors can accumulate shares in both in bull and bear market, what the analysts call as rupee cost averaging or averaging your purchases. Don't put all your savings in one glamorous IPO. Tech stocks around the world are highly volatile, and tech stocks have corrected and will correct easily 40 to 50% before they recover and resume their growth. Unlikely to happen in a large cap bank or an Infosys or this, but it can happen in tech stocks because you don't have this. So learn the trade, learn how to evaluate, judge these companies, because you clearly cannot do it on earnings per share, growth of EPS. All the standard metrics are out now. You need to have new metrics to be able to evaluate. So that would be my thinking. Also beware, as China has shown recently, there are regulatory risks associated with tech companies. There is a FDA policy, there is an e-commerce policy that is there. Okay, right? So if you don't have the stomach for regulatory risk, be wary. In China, because of changes in regulations, the stocks are down anything between 50 to 90%, as Chinese government is moving to control the tech monopolies. Okay, right? So Indian government has been mixed. Unlike US government, which is very startup friendly, Indian government has had both startup friendly measures as well as things that are more controlling. Therefore, you need to be slightly more careful if you don't have the stomach for high regulatory risk. E-commerce, fintech, last mile delivery, GST changes, all of this creates slight amount of concerns. But again, I'm just flagging it. It does not mean that there's not money to be made. I would strongly recommend over a period of time, build up a portfolio in tech stocks. There. Be careful about regulations. As election pressures increase, Indian government will turn more labor friendly. They will worry more about the vote banks and therefore might begin more regulations. All of this leads certain unpredictability and risk for tech startup. Okay, right? So if you don't have stomach for it, stick to HDFCs and Infosys of the world, which have flourished over decades across every regime and every government that is there. New startups have to prove themselves, and how they cope and survive in an ever-changing regulatory environment, they still need to be seen. But I am very bullish. Won't be able to comment on specific stocks because I don't play them.
Actually, you've answered my next question as well, and it was going to be exactly on the risky nature of these tech-oriented companies. You mentioned that they are volatile around the world. We've seen higher volatility for this segment of stocks. There are regulatory risks, and that's been very aptly seen in the recent China crackdown on some of its tech stocks. So you must have the stomach for the risks surrounding these tech stocks. If you don't, you'd rather stick to the HDFC Bank and Kotak Bank and Reliance Industries. Now, my next question: a lot of our retail investors, Ganesh, want not just of course that capital appreciation, but also they have expectations of a dividend. But here, Ganesh, we have loss-making companies. We look at things like cash burn that all of these companies do have. Would it be wrong for retail investors to expect some sort of dividend from these companies?
Yeah, no, absolutely. I think dividend expectation should not be there at all. There will only be capital appreciation. As we have seen, even with angel investing, venture capital investing, private equity investing, this asset class is for capital appreciation. It is not for dividend. But actually, I am slightly amused by this expectation of dividend. I know that investors look at it. When you buy a stock at 40 times, 50 times price to earnings ratio, the dividend is really very small. If you are really looking at dividend, then why don't you just go to debt mutual funds or other things that you recommend in your show to be able to get the dividend? This is especially tech IPOs, and we are talking about is highly volatile stock, okay, right? And they are not going to make profit. You cannot give dividend out of the capital that you have raised. Therefore, dividend is very, very far away. Not just the dividend, even the fluctuations are going to far away. So my advice will be, if you are looking for dividend, if you are looking for income, mutual funds, debt funds, and maybe some stocks that have consistent dividend payout record, you can go for those which are there. But coming to tech stocks, out of that allocation, wherein you are not expecting dividend, you are willing to take high risk and you're willing to take high return, this has to come from that portion of your portfolio allocation, that for dividend. Dividend is not going to happen anytime soon. They've all said that. What we look for, of course, in these companies is certain path to profitability. So I'm not saying dividend will never happen, but not in the short term. As long as their unit economics, unit metrics are good, positively trending, and there is light at the end of the tunnel, there will be some convergence in years to come. We will rate them positively. We look at these companies positively. But for them to make a profit and declare a dividend is many, many years away.
Okay. These are not companies that you can look to adding to your retirement portfolio thinking that, okay, the frequent income from these portfolio of stocks will help you sustain your post-retirement years. Definitely not. They're risky in nature. You have to have a long-term time horizon as well, like Ganesh said. Accumulate them slowly over 2, 3, 4 years and look for capital appreciation more than, that frequent income. There are other, investment instruments for that. This particular class of assets serves a very different purpose, and that is long-term wealth creation purely through capital appreciation.
Can I just add
so, Ganesh, we must forego dividend. We must not look. Sure, go ahead, Ganesh.
Yeah, no. So I just wanted to slightly clarify. See, what you mentioned. I think even if you're retiring now and getting a corpus on retirement, you must look at small portion of it in these assets, because while you may get dividend, you may get your interest income and all of those. Okay. They barely beat your inflation. So if you're a 60-year-old, I'm 59 years old, that's why I'm taking that example. Okay, right? So if you're a 60-year-old and you're retiring, you have another 25 years of active life to live. You cannot live on just interest income or fixed income or dividend income alone. Obviously, you cannot take 50% of your retirement corpus and put it in this stock and then see it fluctuate widely. But you do need some small portion to be invested in this so that you are able to get returns that beat the inflation. So I would just qualify your statement saying, take a small portion and put it there so that they are able to help you as an overall portfolio to beat inflation and get you returns that you want. Otherwise, 10, 15 years later, when you are 75 years old, after 15 years after retirement, you may find a situation where your corpus that you had when you retired is not able to give you enough returns to maintain your same standard of living. So that's just a caveat or a tweak to that statement, but clearly be very cautious about the risk involved here and expose only a small portion of your total corpus funds.
Well, it's very subjective for sure. If you feel that you don't have the appetite, then maybe avoid altogether. But if you feel that, you want to explore this theme and, you want to sort of participate in this new and upcoming sector, then by all means go ahead, put a small portion, dip your feet little by little before you, start taking bigger bets. That's really the advice. And yeah, even for those retiring, I think Ganesh has put it quite rightly, because at the end, Ganesh, we always think of retirement as being the end goal, but actually even after retirement, financial planning is an ongoing process. You still have 25-30 years, so that's still a good enough timeline for these companies to be able to deliver the returns that they have potential to deliver. So 40 or 140, Ganesh, that's really the question that everyone's been asking for Zomato. The most bearish view which we've got from Aswath Damodaran has been that, I don't value it more than 40 rupees Zomato. But then you have other brokerages saying, no, it's trading at 140. Some are saying 150, 160. I've heard a valuation as high as 180. So it can be quite contradictory for a retail investor to decide on, what really is the actual value. But do you think, Ganesh, that, like you mentioned, you should really keep valuations aside when it comes to these companies and only look at some of the things that you mentioned, like, the business model, unit economics? Do you think valuations should be totally kept aside here?
Yeah, so, no, very clearly, there is no right answer. Aswath Damodaran is a well-known person in valuations circles, but he has got it wrong several times, including Uber valuation. Socrates or somebody said, over long term, everybody is dead. If you keep having a bearish view, sometime or the other you will turn to be correct. You will be proved right, and you will do that. You will be proved right. But the bottom line is that tech is here to stay. Software is eating the world. Consumers have spoken. Indian consumers have moved in droves online, right? And right now, retail investors can finally participate in the gold rush, if I may call it so, as a lot of tech giants are going public and laws have allowed loss-making companies to be able to list. So here is a new opportunity that has suddenly opened up, which is not available, where all the listings were with companies which are making profit. Okay, right? So with this opportunity available and people moving online, preferring convenience of smartphone and ordering, and India being huge market with huge amount of challenges which can be solved only by tech platforms, that is the way to go, okay, right? There is no other way to go. Whether it's any product, groceries, medicines, fresh food, cab, any service, tech-enabled models is the way to go. And that's what we are seeing. Consumers in any zip code can order the same product, which was not possible earlier because all the major retail chains were in main cities or big cities or tier 2 cities. Tech has solved the problem of access. So that's the way to go. Now, specifically, is Aswath Damodaran right? Is somebody right? It really doesn't matter. What matters is if you come in today, because it's a fully liquid stock, will you be able to exit tomorrow at a price which is higher? And compared to this, is HDFC a better bet? Is some other stock a better bet? That is a concern. So valuation will always be a concern. Buy small amount of shares in each company, accumulate it over time, sell it accordingly, and learn the ropes. Like you rightly put it, dip the toes in water and see how it goes. Is there? Again, personally, I will not be able to comment whether 40 or 140 is 140 or 140 is right. But across all these tech stocks, this question will always be there in absence of standard metrics that is there. Because what we look for as private equity, as angel investor or venture capital investor, is the valuation. Okay, right? Value in the company that determines the valuation. Now, once you are public, you are getting valued every minute. As whenever one person is buying, one person is selling, the company is being valued. And this is a function of demand supply rather than anything else. I think we should ask the people who play the market to be able to do technical analysis, various analysis, to say that is it forming this curve or that curve and is the value right. But don't miss out on the entire opportunity of textiles. I mean, Zomato being the first one getting so much of attention. Over a period of time, as other companies list, we will get more data, and let's wait and watch the performance. I think it will take about 1 year before we can credibly answer the question that you asked, because people who have invested for the IPO pop will sell. Lock-in will get over. People who have employee stock options or people who are promoters, people who have got lock-ins will sell. After all this, you will also see 4 quarters of performance and transparent reporting of metrics. After that, it will stabilize. Right now, it's too risky to guess 140 or 40.
All right. Well, I think we've got a thorough idea of how retail investors today can approach these counters. Don't expect dividend for some time. These are companies which operate at a different business model and a different scale. But these companies have capital appreciation potential. Ganesh has given a rough guideline of all the parameters that you should look at. Keep valuations as well on the side for a bit, because valuations will always remain a concern. But yeah, you can slowly accumulate them. Be slow, be aware of the risks as well involved in this before you dip your feet. Ganesh, thank you so much for joining us today on The Money Show and helping our viewers as well out with how they can as well don your hat and sort of get into the world of new age tech companies. Thanks once again.
Thank you very much.